Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Anthony Cross, manager of the Lion Trust Special Situations Fund. Hello, Anthony.
Morning.
So you're here today to give 3 stock picks from the UK market.
Yep.
What is the first stock?
Well, the first stock is a company called EMIS. It's a software business. It's a company we've owned for a long period of time. It's involved with providing software, particularly into the GP, general practitioner market, and local pharmacies. But it is moving more into the more general healthcare market, into the hospital market.
And how dependent is that on public sector revenue streams? Because we're having cuts seemingly every day.
Well, they've just gone through a renegotiation stage. Of course, it's money comes largely, very much largely, from the public purse. But the interesting thing about software going into the NHS and in other industries now, in particular, is that they are reducing the costs for the health service. And therefore, it's a very important part, actually, of trying to make the healthcare system more efficient. Because
I suppose, actually, a great number of GP surgeries are, in essence, small businesses. So being able to outsource costs is a good thing.
Yeah, it's all really, ultimately, it's all about kind of workflow. So they hold all your records, your healthcare records. The healthcare system is trying to become more joined up, so that EMIS, with all those healthcare records, is in a very key position for being able to provide information and information flow right through the healthcare system.
And what's the second stock today?
Second stock today is one that everyone knows, the beloved AA, one of the most trusted brands in the UK. And as you recall, we like brands and intangible assets. But the key intangible asset for us with the AA is the scale of its distribution network and its recurring income. It's a company which has got scope to improve efficiencies a lot. It came out of private equity. So it's rather nice because you've got the strength of distribution, the strength of recurring income, the strength of brand, but actually scope to improve profitability quite a lot over the next few years. And the other aspect about it is that it came out of private equity, as I've said, with a lot of debt. But it is a very cash-generative business, and a lot of the debt was quite expensive, as in the structure was quite expensive. So the more you can pay that down, the returns to equity holders can flow through very nicely. So a mixture of improving the efficiency of the business and growing the profitability, as well as slowly but surely changing the balance sheet structure of the company, makes it an attractive investment.
And which side of the business do you prefer? Do you prefer the insurer? Do you prefer the road recovery? Or is it a company as a whole that you like?
Well, the company as a whole is nice. The road recovery, I think, is the more exciting area. But there are spin-off services that you've got an amazing database of people and people that trust your brand. Insurance is actually quite a tougher market, and I've always been less keen on insurance-style businesses.
And what's the third stock today?
Third stock is a more recent issue, a company called Sarn, which is a fund administration business. I like it because it's got lots of recurring income and good long-term contracts. And it's the sort of business that once you've captured a client and you're doing the fund administration for them, as long as you're providing a great service, they're very happy to stay with you. So things become very sticky. Clients become very much embedded within you. And the other good thing about the business is it's not a company that's seeing any great pricing pressure, because ultimately it's the funds that pay for the administration. And the fund manager is therefore much more concerned about getting a good quality service than they are trying to get a cheap service.
You say that there's been, as you well know, so much pressure on pricing within the fund management industry, within the asset management industry. Just the fact that ongoing charges are coming down, surely then that means that fund managers will be less willing to pay quite so much for a quality product.
Yeah, but it's not the fund managers who pay, it's the fund that pays. And that's where the fund manager is much more concerned about getting the quality of service and not having a regulatory issue on their hands. And that's why something like a fund administrator is not seeing great price pressure.
So actually it's beneficiary of all this new regulation.
Oh, yeah. And interesting enough, a number of companies are coming to the market now. In our small cap fund, we've just done a stake in a company called Curtis Banks, which is a SIP administrator. So out of all this regulation are coming some quite interesting companies with lots of high recurring income.
Anthony, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.